Right. Good morning, everybody. Happy Monday, all you magnificent melonheads. It's 9 a.m., September 25th. A new week is upon us, and all the wonderful possibilities that comes along with that. And of course, what better way to start the week than with unelected bureaucrats, central bankers all over the world, making a fine mess of things, pulling in opposite directions, leaving innocent people in the middle to figure what the heck should I do? How do I protect myself from these overreaching a-holes? That is what central bankers all around the world are doing this morning. Of course, we had the Fed last week. Jerome Powell, with his hawkish tone that he took at the FOMC meeting, something that didn't really surprise me, probably didn't surprise you melonheads, but for whatever reason, the market is just shocked, totally shocked, even though Jerome Powell said exactly what he was going to do, and the market just didn't believe it. Well, this morning, it seems like the European Central Bank is getting in on the action. Again, they're kind of putting the hammer to this pivot talk. We had one of the governors of the French Central Bank, which I guess the French Central Bank is beholden to the European Central Bank because of the way they do business in the Eurozone, basically said, don't expect a rate cut anytime soon. Market did not like that. You can see it in the timestamp. It was around 4 a.m. Eastern time this morning. You saw all the stock indexes took a move to the south on those comments from the European Central Bank officials. But it wasn't just the ECB that was getting in on the action. We also had the Bank of Japan. We had BOJ Governor Ueda. He's their new governor. He was widely expected to be a hawk. A lot of people thought when Ueda came in, he replaced Kuroda as the head of the Bank of Japan. A lot of people thought day one he was going to be this uber hawk who was going to end decades of yield curve control policy and easy money in Japan and low interest rates and negative real rates. Everyone's like, man, day one, Ueda is going to change all that. Nope. I mean, here we are in September, almost October. Where did September go, by the way? Almost October, and he still has just barely tweaked that Japanese policy of yield curve control. And then yesterday, Friday afternoon through the weekend, I'm not sure when exactly the soundbite came out, but it's in the news this morning. Ueda came out and basically said, yeah, we've seen some encouraging things. We've got inflation is starting to pick up a little bit in Japan, driven largely by oil prices. But he said we're going to keep our easy monetary policy in place probably for a little while because he's not convinced this 2% inflation is going to last in Japan. He's worried about deflation at a time when oil prices are skyrocketing. That's interesting. By the way, I also am in the deflation camp. I see central banks creating dollar shortages. I see money getting more scarce and interest rates rising as a result of that. And then we even had the Philippine Central Bank getting in on the action this week. We had the Filipino Central Bank governor came out and basically said they are going to defend the Philippine peso at a value of 75 to the dollar. It's currently just below that. The Philippine Central Bank was also among the many central banks back in October who stepped in to defend their currencies. I don't know if you guys remember, back in October of last year, the DXY was up around like 115. The super strong dollar, the dollar milkshake theory, everybody was talking about it. And then one by one, central banks across the world all got in on the action and decided they were going to dump some of their dollar reserves to try to prop up their own currencies that were in decline. Well, the Philippine Central Bank is saying we are going to do the same thing at a level of 75, which is a little bit lower than the level they did it last time. But a lot of people are expecting at some point Japan is going to do that also, although Ueda just told us last night he's probably not going to do that, at least not today. But a lot of central banks in Asia are being forced to defend their currencies against the U.S. dollar, which is getting so strong because of what's going on in Western central banks. You've got this East-West divide where the Western central banks are just bringing down the hawk hammer, raising rates, quantitative tightening, driving dollars higher. And then you've got the Eastern central banks, the PBOC, which is tweaking policy in dovish directions all over the place, avoiding the fire hose or the bazooka of liquidity for now, but still very dovish moves from the People's Bank of China in response to the Evergrande crisis and their real estate crisis, which, that just got worse. Put a pin in that. And you've also got the Bank of Japan that's still maintaining their dovish policy. So you've got hawks in the west pulling in one direction. You got doves in the east pulling in the other direction. People in the middle just wondering, what the heck do I do? And I mentioned Evergrande just got a little bit worse. Evergrande had a plan to restructure its debt, but apparently that plan was hinging or dependent upon being able to issue some new bonds, and they weren't able to issue those new bonds. So at the last minute over the weekend, Evergrande canceled their plans to meet with their creditors for this debt restructuring deal. They basically scrapped the plan. Well, that means that we're now closer to that worst case scenario where Evergrande just turns off the lights, shut everything down, sell it all, pay back what you can, end of the world for Evergrande. Now, that would be a worst case scenario for the Chinese economy if that happens, because if Evergrande sells, and if they just liquidate everything, they don't try to save the company and restructure, well, then now we finally find out what these buildings are worth. Now we finally find out how much money the banks actually lost when Evergrande liquidates and says, okay, folks, that's all we've got left. If you're still in the red, you're SOL. So we could see a large devaluation of Chinese assets, Chinese bonds, and we could see big write-downs in the banks that own these assets if Evergrande goes into liquidation. That would be probably the worst case scenario for the Chinese developers. And Chinese developers across the board are down big time this morning as a result of that. So with that, let's shrink my big melon of a head and see what's going on in the world today. While we're shrinking my head, won't you please hit that like button for the YouTube algorithm? It really helps the channel out, helps get this message out. And if you're new here, won't you subscribe to this channel? We do this every morning, and I would love to see you over your coffee tomorrow at the same time. Fear Greed Index. We are now firmly into fear territory. Big lurch to the left on the Fear Greed Index. Back at 35 now. We were hovering in neutral territory for a while. It seems like Jay Powell has finally put the fear back in this market. This morning, we've got S&P futures are set to open 17 points lower. This is after 3 consecutive days of the indexes closing at the daily lows. Stocks showed tremendous weakness last week, guys, after the Fed. Every single day, Wednesday, Thursday, Friday last week after the Fed, the market closed at the low of the day. This thing is heading lower. And so far, it has not even looked back once. S&P set to open another 0.4% lower this morning. We've got the Dow set to open 113 points lower, another third of a point to the downside. And something I want to show you guys right around 3:30, 4 o'clock in the morning Eastern time. That's 4 a.m. You see how markets took a big dive here. This was those comments by the French central banker talking about how there were not going to be a rate cut anytime soon, that people shouldn't be holding their breath on those rate cuts and the return to dovish policy. Markets definitely did not like that, sold off on that news. You also saw it in the S&P here, and you see it in the NASDAQ also. NASDAQ down 76 points, a full 0.5% this morning, set to open before the opening bell. Currently at the low of the morning and heading lower. We have got a big red candle right now in the NASDAQ. The DXY, meanwhile, is getting stronger. And guys, this is why I am in the deflation camp, because I see currency getting more scarce. I see the money supply shrinking. I see the dollar strengthening. I see interest rates rising. These are all things that make prices go down over time if they are sustained. Currently, the DXY is at 105.76. That's up another 18 basis points today. Pushing, man, we could see a 106 handle as soon as the next few days if this thing doesn't change direction soon. And bond yields are heading higher once again this morning. Check out the long end of the yield curve. The 30-year Treasury up almost 10 basis points this morning, 4.62% on the 30-year. The 10-year now over 4.5, 4.52, up 8 basis points this morning. The 2-year, odd exception here, the 2-year is a little bit lower, a half a basis point lower at 5.11. And, of course, the 1 month never moves, 5.39, held in place by the Federal Reserve. Check out this long-term chart of the 10-year Treasury, guys. We have now broken above the psychological resistance level of 4.5. We'll see if we stay above that today. We made a few runs at it the last couple of days, but now we are firmly above it here at 4.52. And look at what interest rates are doing here. Up, up, up. Money is getting more expensive. This is credit cards getting more expensive, auto loans getting more expensive, mortgages getting more expensive. In a debt-based economy, this is not good, guys. We can't keep this going much longer. Looking over at the commodities board, we've got gold, which held up exceptionally well last week during the higher interest rates and the stronger dollar. December gold futures still at $1,945, down just 20 cents this morning. Precious metals have done remarkably well in these last few days, guys. Normally, a stronger dollar and higher interest rates would send these metals diving, but they are doing very well here, holding up. Now, they haven't exactly gone up. They're still going down, but they've gone down a very modest amount. So surprising strength while everything else is showing weakness. December silver futures at $23.72. That's down about 14 cents this morning, or about 0.57%. We've got platinum and palladium are also both down about 1% and change. And West Texas Intermediate is pretty much unchanged, up 2 cents this morning, $90.05 for November WTI futures. Here is the main story this morning, though. This is what was moving markets around 4 a.m. this morning. Betting on a rate cut is premature, European Central Bank member says. We should remain at this level for a sufficiently long period of time, said, I'm going to get this name wrong. Sorry, guys. Francois Villeroy de Galau. How's my pronunciation, guys? How's my Francais there? That's France's central bank governor said about interest rates in the Eurozone. The ECB hiked rates once again earlier this month, bringing its main deposit rate to 4%. A poll published by Reuters earlier this month showed that economists do not expect further rate hikes from the central bank this year and suggested that rate cuts could happen in the second half of 2024. But it looks like Francois doth beg to differ, because he says it is premature to bet on a cut to interest rates. That's according, again, to Francois Villeroy de Galau, France's central bank governor. He told CNBC as market players were considering whether the European Central Bank had reached peak rates. We should remain at this level for a sufficiently long period of time, he told Annette Weisbach exclusively on Monday. Betting now on the next cut is probably premature. I just want to emphasize that, guys. The central bankers keep saying this, and the market keeps disagreeing. Betting on a rate cut is premature. They're not cutting anytime soon, not without something really bad happening in this market. I don't know how clearly. We can write it in the sky and smoke, or we can have one of those big banners dragged behind the plane. We could put a billboard at Times Square. Maybe if Taylor Swift were to say it, people would listen. They're not cutting rates anytime soon unless everything breaks. And if everything breaks, you don't want to be in stocks. There, I said it. The ECB hiked rates once again earlier this month, bringing its main deposit rate to 4%. The benchmark rate had stood at negative 0.5% back in July of 2022 before the central bank embarked on their intense hiking cycle. What else we got going on this morning? Oh, we've got other central banks in the news. How about the BOJ, guys? Look at, here's what Hirohito, that was Kuroda's first name. Central BOJ Governor Ueda, he's warning of highly uncertain wage and price outlook. Now, it doesn't really seem like that big of a headline, but this is a very important thing because the yen to the dollar exchange rate is the key to that yen basis, or that yen carry trade, where people borrow money in Japan, trade the yen for dollars, and then buy U.S. assets with it. This has really been propping up a lot of the U.S. market. So a tightening cycle in Japan would mark the unwinding of that, which could be very bearish for U.S. assets, but it looks like that is still a ways off. Bank of Japan Governor Kazuo Ueda said there was a very high uncertainty over whether companies would continue raising prices and wages, stressing anew the bank's resolve to maintain ultra-loose monetary policy. That's the operative phrase there in this whole article here. This is the BOJ governor stressing anew the bank's resolve to maintain ultra-loose monetary policy. So that unwinding of the yen carry trade is not happening this week, this month, probably not this year. That's according to what Kazuo Ueda is saying. He also offered a cautious take on the overseas economic outlook, warning of fallout from aggressive U.S. interest rate hikes and sluggish growth in the Chinese economy. So there's that east-west divide in central banks. He's saying, hey, we're not doing anything. We're staying dovish. And what they're doing over in the West with their rate hikes, that could cause big problems. And so we're not going to change anything over here in Japan. The key to the outlook for monetary policy is whether strong wage growth and consumption, rather than cost pressures from rising import costs, becomes the key driver of inflation, Ueda said. So he's saying now we want to see wages go up. We want to see Japanese consumers spending money in stores. We don't just want to see higher oil prices and higher food prices being caused by the dollar getting stronger. We want to see what he refers to as the virtuous cycle of inflation, where people make more money and therefore spend more money. He wants that kind of inflation. He doesn't just want to see commodity inflation, which is what we have right now. And I just want to show you guys the U.S. dollar to Japanese yen. Currently, a U.S. dollar is worth 148.78 yen. And that is the highest it has been since back in October, which was the last time the Japanese got involved and decided to protect their currency. A lot of people believe 150 is the level where the Japanese will step in and start dumping their U.S. treasuries to get dollars to defend the yen. That would put further upward pressure on U.S. interest rates. So that is kind of the unwinding of the yen carry trade that people are worried about. That happens around 150, or at least a lot of people think it does. We're currently at 148.78. But right now, UAID is saying don't hold your breath on that one. And check out the Philippine Central Bank. They're getting involved this morning too. Philippine Central Bank signals peso intervention at 57 to the dollar. The peso is among the worst performing Asian currencies this quarter. The BSP won't intervene a lot if the peso slides with other currencies. Philippine Central Bank Governor Eli Remolona signaled officials are intervening to defend the peso at 57 per dollar level to prevent the currency from weakening further. There are resistance levels, and when those are crossed, you'll suddenly see trades in the same direction. There's hurting, Remolona said in an interview on Monday, when asked if the central bank had been keeping the exchange rate from breaching 57 per dollar. So not going to get too deep into this one, but the Philippines are defending this level in the peso. They don't want it to weaken further against the dollar. You can see this in this chart of the Philippine peso. They've been doing it, it really looks like since around August. You know, as we get up around 57, 56 and change, it keeps coming down here. It got as high as 57.04 before being pushed down. But you can clearly see here there is resistance at this 57 level. That was the Philippine Central Bank intervening to defend their currency, and they're telling us that they are going to maintain that. So that involves the Philippines selling their dollar reserves to buy their own peso. That drives down the value of the dollar and up the value of the peso. They have to do that because the Filipinos, they import all of their oil. Well, they have to pay for their oil in dollars. If the dollar gets too strong, then they lose on the Forex. They'd have to print pesos to buy dollars to buy oil. So they're trying to defend the peso here. This is another reason why I'm worried about deflation. As the dollar strengthens, the dollar shortage causes problems all over the world. And we see dollars getting scarce everywhere. And lastly, check this one out, guys. China Evergrande shares fall after the developer scraps their restructuring plan. China Evergrande shares fell early Monday after the property developer scrapped the $35 billion debt restructuring plan designed to ensure its survival and said it's unable to issue new debt. Shares declined 19.1% to 45 cents that's 45 Hong Kong cents. China Evergrande fall also weighed on the other mainland property stocks listed in Hong Kong, with Shimeo Group Holdings declining almost 8%. Guangzhou, my pronunciation, I'm sorry, they dropped 6.6%. The troubled property developer said in an exchange filing on Friday that it needed to cancel key creditor meetings and scrap its restructuring plan due to worse than expected property sales, and that it would search for another path forward that reflects the company's objective situation and the demand of the creditors. The world's most indebted developer proposed plans for restructuring in March to its creditors with options to swap debt for new bonds and equity-linked instruments. The company's total liabilities amounted to about $327 billion. With a new deal, bondholders who lent around $15 billion to Evergrande could pursue a liquidation of the company, which could further weigh on China's already crippled real estate market. It's that liquidation, guys. Worst case scenario for pretty much anyone in China. Also, in a separate exchange filing on Sunday, China Evergrande said it was unable to issue new notes as its onshore subsidiary, Hengda Real Estate Group, is being investigated. So Evergrande, the hits just keep on coming. It looks like this one is headed for liquidation. Oh, and don't worry, guys. Country Garden is still going on. You've still got Aoyuan. You've got all these other Chinese developers that are either bankrupt already, on the brink of bankruptcy, missed bond payments, running down their 30-day grace period on debt. The China real estate collapse is still happening. It falls from the headlines every now and then. It goes quiet for a few months, but you cannot unwind a $30 trillion debt bubble easily. It just can't happen without pain. And this liquidation in China Evergrande, watch out for those Chinese banks, watch out for those other Chinese developers. Not going to end well for anybody over there. And I got a couple of thank yous I got to send this morning. Mr. Mike Kathman says, let me see that Perma Bear sleeve. There it is written in invisible ink, Mike. Perma Bear right here. I wear it on my sleeve. He says, let me see that Perma Bear sleeves. If you had to pick what's going to break this market, that's tough. If I had to pick, all right? So, because let's take your pick, guys. Let's list all the risks that are out there, all the potential black swans. We had the Airbnb thing we talked about in the live stream on Friday. A sudden deluge of new housing supply caused by these short-term rental bans. That could collapse housing. I think that one's probably going to take too long. I don't think that will be the one that does it. It could, but I think something else does it first. I don't think it starts in housing this time around. What else? We've got the return of student loan payments. That could cause a collapse of retail spending, a shrinking of GDP. That happens in the next few weeks. That could cause a problem. But we've also got the China Evergrande crisis, right? I mean, that could cause contagion in the Chinese banking sector that could spread to U.S. or European banks. That's another thing that could cause this problem. We've got the losses, the unrealized losses from U.S. treasuries caused by the Fed's rate hikes, right? That's still sitting on the balance sheets of banks. That's what took down Silicon Valley Bank and Signature Bank. That could cause a problem. But if I had to place my bets, right, if the roulette wheel's spinning, I got to put my chips on one number, I would say commercial real estate. And the reason why I would say commercial real estate is because we have bank earnings start up in a couple of weeks here. Mid-October, the bank earnings start. And I have seen that a very large number of these commercial real estate loans that are maturing, almost all of them are either outright defaulting with the owners handing the keys back to the buildings, or they're going into some kind of special servicing, some kind of distressed negotiation with the banks to extend and pretend. Either way, commercial real estate, I think that's the truck that hits us first. I mean, we've got 10 different trucks barreling towards us. I think commercial real estate gets here first. And, you know, if you get hit by a truck, do you care about the second truck that hits you? Probably not. And bank earnings start up in mid-October, and most of this commercial real estate debt is sitting on the balance sheets of America's small banks. And America's small banks are the most vulnerable to the issues that have already taken down Silicon Valley Bank and Signature Bank, the losses from U.S. Treasuries. You've also got a lot of distressed credit card debt that's sitting on the balance sheets of small U.S. banks. So what I'm most worried about over the next few weeks is small banks starting to go under when they report in the next few quarters. And maybe they don't outright fail right away, but if a small bank reports a big hole in its balance sheet, then you're going to see people start to pull their money out of that bank. You're going to see that bank's stock price start to collapse. If the stock price collapse, then they'll have a hard time raising capital, raising cash to fill that hole in their balance sheet. That could spook investors. That could spook depositors, pull the money out. Next thing you know, that bank is insolvent, and the big banks would just love to come in and gobble up them and their assets at a discount, leaving the taxpayers to make up the difference. That could start in the next few weeks. I'm not saying it will. I don't want to be accused of fudding and too much fear. But all the issues that failed banks back in March, they're still out there. And the commercial real estate thing is now getting worse quicker. So that would, if I had to pick one, I'd say commercial real estate is the straw that breaks the camel's back. Thank you, Mike Kathman. I appreciate the super chat, the support of the channel, sir. And thank you, Steve Woitas, for your super chat, sir. He says, with my 10-year coupons above 4.5%, do you think the bond market will siphon liquidity from the stock markets? I can tell you the bond market already siphoned my liquidity from the stock market. Why am I going to buy the S&P 500? What's the S&P 500 yielding? Like 2% right now, interest. Forget capital appreciation and depreciation. Just look at the yield, right? The dividends in the S&P 500, somewhere around 2%. Why am I going to go to the S&P 500 for 2% and take on all the risk with stocks at ridiculously high valuations and all the black swan events that could come in and trigger a stock market sell-off that I just listed in Mike Kathman's question? Why would I go to the S&P for 2% and take all that risk when I can get twice as much yield for zero risk in 1 month U.S. Treasuries. I should say near zero risk. Okay, somebody's going to say, oh, zero risk, the government could default. Yeah, they could. And the government shut down and all that other stuff. But you know what? They also suspended the debt ceiling. So the government gave themselves a blank check. So I see the bond market right now, especially the 1 month Treasury, as near zero. So all my liquidity, most of my liquidity, I still own a few stocks, but very few. Most of my liquidity is now in the 1 month Treasuries. You know, I'll take the 4.5%. If the government wants to bankrupt itself and drive itself insolvent with these high interest rates, I'm going to pay for it on the back end, either in the form of some kind of deflationary collapse or in the form of higher taxes or inflation later on in my life. I might as well get paid now and collect that 4.5% interest. So, yeah, I think the 10-year, not so much. I just realized the 10-year at the beginning of the comment. I think the 1 month is siphoning liquidity more than the 10-year. I don't think people are really buying the 10-year right now, which is why the interest rate on that is rising. I think why commit your money for 10 years when you can get more yield for 1 month? So I think it's the short-term interest rates that are probably stealing liquidity from the stock market more so than the 10-year or the 30-year. The real risk with the 10-year is that all the other borrowing rates in the economy are dependent on that, right? Mortgage rates are dependent on the 10-year. Credit cards are dependent. Auto loans dependent on that. Business loans. So as the 10-year yield rises, that further stresses the income statements and the balance sheets of all of these companies that are in the debt market for survival right now. That's the real risk from the 10-year, not so much robbing liquidity from the stock market. I think the short end of the yield curve is doing plenty of that already, so that doesn't really matter. But thank you very much, Steve Woitis. I appreciate the super chat and the support of the channel. Thank you, everybody, for your time this morning, and to my Patreon supporters for everything you guys do for the channel. Don't forget, guys, we are just a few days away from the Stock Pulse Silver Symposium in beautiful Las Vegas at Caesars Palace. Use that link below in the description to get 10% off your tickets. I'll see you guys in Vegas in just a few days. Also, hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.